Oil prices sink after US and Iran pause fighting a second day. On Monday, markets reacted to the temporary halt in hostilities between the United States and Iran, with Brent crude slipping 8.7% to $88.36 a barrel for September delivery and West Texas Intermediate dropping 7.5% to $82.61 a barrel for the same contract. The decline came after a period of heightened tension that had pushed oil above $100 a barrel earlier in the week, following threats from the Iran-aligned Houthi group to blockade Saudi Arabian ports in the Red Sea. The article notes that oil prices had been rising through most of July as the earlier ceasefire between the two countries collapsed. Last week's spike above the $100 mark was driven by fears that the Houthis would interrupt shipments through the Red Sea, a vital route for crude heading to Asia. President Donald Trump's decision to hold off, at least temporarily, on a major escalation of the conflict brought a sense of relief to traders, who began to hope that a diplomatic resolution might allow more energy to flow from the region. Despite the optimism, shipping remains disrupted. The Strait of Hormuz, the narrow waterway between Iran and Oman that carries a large share of global oil exports, saw only 11 vessels pass on Sunday, up from 6 the day down from more than 130 ships on average before the war. Analysts point out that the continued danger in the strait, coupled with threats to another choke point, the Bab al-Mandab at the mouth of the Red Sea, keeps market participants cautious. In the Red Sea, the Houthi blockade of Saudi ports forced several Saudi vessels that were originally bound for Bab al-Mandab to reverse course and head toward the Suez Canal. Some of those ships later turned again and transited via Bab al-Mandab, indicating that operators are not uniformly avoiding the route. Because most Saudi crude is destined for Asia, the alternative routing via the Suez Canal, the Mediterranean, and around the Cape of Good Hope adds roughly 4 weeks to the journey. The article cautions that it is still too early to gauge the full impact of the Houthi threats on Red Sea traffic. Data from shipping analysts show that the volume of oil and other products moving through Bab al-Mandab has fallen about 50% compared with the April through June period. The number of supertankers using the strait has also dropped, averaging just 1 per day over the past week, down from an average of 3 per day in the second quarter. Overall, the daily average of all vessel types transiting Bab al-Mandab remains around 31 ships. Investors and analysts continue to monitor these waterways closely, as any further escalation could renew the upward pressure on oil prices, while a sustained de-escalation might allow markets to stabilize. That's the latest on the oil market reaction to the U.S. Iran pause. Thanks for listening, stay tuned for more updates.